Hey. Welcome back to the What the Wealthy Do podcast, a podcast where we pull back the curtains on the strategies that the wealthy use to build wealth and show you how to apply those same strategies to your daily lives on your own individual wealth building journeys. I am your host, Stephanie Dorsey, the CEO and co-founder of Margins Capital. Margins Capital is an investment firm that provides women and people of color access to an institutional quality portfolio of alternative investments. All right, so over the past 2 weeks, we've been deep in due diligence for stocks, the qualitative and quantitative analysis you need to do before you buy a public company. But here's the thing, the really wealthy don't just invest in stocks. They put significant portions of their wealth into private equity and venture capital. Why? Because that's where outsized returns are. When you invest in a private company, you are theoretically investing in it when it's earlier in its life cycle. Therefore, it is riskier and you get paid for that risk. That's where you can get in early before a company goes public. And this is where you can access deals that the average investor will never see. But here's the catch. Private investments are riskier. You can't just Google the PE ratio. There's no stock ticker. There's less transparency. And if things go south, you can't just sell your shares in the open market. So the due diligence process in the private capital market space is even more critical. Today, I'm walking you through Margins Capital due diligence framework for evaluating private equity and venture capital deals. So this is the exact process that we use when we're deciding whether or not to invest in a company or a fund. And yes, I'm going to show you how to apply this even if you don't have millions to invest directly. We don't have millions yet, let me be clear. We are not investing millions, but we are still employing the same rigor to every opportunity we invest in because I am investing my people's money and I know how hard you work for it and I know what you've been through to get it. And I want to make sure that I am exacting the same stewardship over your dollars as I do over my dollars. And I don't play no games. All right, but before we get into it, you know what it is. This podcast is intended to provide financial education and not financial advice. So you take it, you put it through your own filter, you throw some of your common sense on it, and that together is how we win. All right, so first, the difference between private equity and venture capital. I want to make sure we're all on the same page before we get into it. Private equity is investing in mature, established companies, often taking them private to restructure, optimize, and eventually sell for profit. Think buying a profitable business, making it more efficient, then selling it 5 to 7 years later. As opposed to venture capital, which is investing in earlier stage companies or earlier stage startups with high growth potential. These companies are often unprofitable, but have big ideas and big market opportunity. Think investing in Uber or Airbnb before anyone knew what they were. In our case, that's SpaceX. We invested in ByteDance, Anthropic, and the like. The risk reward profile is much different. For PE, there's lower risk. There's more predictable returns. The target is about 15 to 25% annually. But for VC, there's higher risk and potential for massive returns. The target is 3x to 10x your money, but many will fail, like over 90% fail, which is part of the reason why at Margins we invest in late stage venture capital because again, I am being a steward over my people's money. So ain't nobody got time to be throwing spaghetti to the wall and hoping it sticks. We're investing in companies that have very much so proven traction and are often already worth billions of dollars before we give them money. We expect them to go public in a 3 to 5 year turnaround. Our ideal portfolio is 50% private equity, 20 to 25% late stage venture capital, and 25% commercial real estate, and we generally leave a sliver of about 5% for an opportunistic investment. We invest in a portfolio like this because we believe that this level of diversification across asset types mitigates risk and maximizes returns. But whether you're looking at private equity or VC, the due diligence framework is quite similar. So let's break it down. There are two big questions that we ask, and this is the exact same questions that we ask for stocks. And we went through it 2 episodes ago, and we're asking, one, does this make sense? What they're trying to do, this strategy, this company, does it make sense? And can they win? Do they have what they need to be able to become the best in class at whatever they're trying to become the best in class at? For this episode, we're going to focus on investing directly in companies. And then next episode, I am going to talk to you about investing in funds. Yes, I'm going to give you the keys to how to evaluate me and my fund to figure out if we make sense for your investment strategy. So evaluating a company, just like with stocks, you need to validate the opportunity itself, right? First question is, what is their strategy and does it make sense? Can you explain what this company does in one sentence? So for private equity, what's the buy and build strategy? Are they acquiring a profitable company and scaling it to the next level? Are they rolling up smaller companies and smaller competitors to make a larger, more profitable company? Are they turning around struggling businesses? And then for venture capital, we ask, what problem are they trying to solve? Is that a real problem that people have and will pay for? And is the market big enough? If you can't explain it simply, walk away. Like, it's too much. And it's funny, we were evaluating a company and I was literally struggling how to explain what it is they do. And I just kept going at it. And eventually we walked away. And here's a red flag. If the company is doing too many things or pivoting constantly, I'm talking about constantly, that's a sign that they don't have clear focus. In private markets, focus is everything. Now, don't be afraid of the pivot. They should pivot. And there are a lot of companies that have pivoted. NVIDIA pivoted. There was a company that ended up being Slack. They started off as a picture company. They were doing something with pictures or whatever. Like, the pivot is real and there might be revenue and gold in the pivot. You got to see it through. And the difficulty is in the resilience. And that's what makes this thing hard. It's like you have to keep working at it and digging at it and working at it. And it might take a while for it to hit. But that focus is what we're looking for. The second question, all right, we're looking at macroeconomic indicators. Do they support this strategy? Is this the right time for this company to be doing what they're doing? For private equity, if they're buying a manufacturing company, what's happening with supply chain and tariffs? We invested in a fund, and the investment strategy for the fund is buying companies that deal with government contracts as well as utility companies. As you can imagine, that government contracts business has slowed way down in light of our current administration. My hypothesis about this administration was that he was planning to privatize everything, and so there would be a lot of opportunity for government contracting. I believe that hypothesis is still correct. It just depends on if you're his homie or not. And that is a difficult thing for us to foreshadow. It is what it is. For venture capital, especially if you're thinking about a SaaS company, you want to be careful of how AI is incorporated into their business, because a lot of companies are thinking how folks thought back in 1998 and 9, like if you put .com on the end of this thing, then you have a sure winner. And that is not necessarily the case, certainly not for AI. And you want to be careful that any company that's being built on top of someone else's model can get like completely gobbled up as soon as Google or Anthropic or some of these big players decide like, yep, I'm going to do that and I'm going to offer that too. So AI is really difficult, right? Because you don't know what's going to happen in the next 3 to 5 years, but you do need to provide some type of consideration to where we're going to be in 3 to 5 years and to evaluate whether or not something makes sense in light of this very, very blue sky space that we're headed to. All right. So the third question you want to ask are, what are the unit economics? And so for venture capital, for every customer they acquire, do they make money money or do they lose money? Early stage startups often lose money as they grow, but you need to see a path to profitability. You need to understand customer acquisition costs, how much does it cost to acquire a customer, and the lifetime value of that customer. So once you've acquired them, how much revenue does that customer generate over time? A healthy ratio of lifetime value to customer acquisition cost is 3-to-1. So if you're spending $100 to acquire a customer, you expect that customer to generate a lifetime value of $300, as opposed to spending $100 to acquire a customer and that customer is only generating an $80 lifetime value. That math don't math. For private equity, you're looking at mature companies, and so they should already be profitable. So look at the EBITDA. EBITDA is earnings before interest, taxes, depreciation, and amortization. A common profitability metric in PE revenue growth trajectory is cash flow. So if a mature company isn't cash flow positive, that's a major red flag. So when we're evaluating, can a company win? So we've already figured out that the strategy makes sense, the timing is right, the economics is right, the macroeconomic trends are right. Now we need to figure out, can this company execute? Execution is what we mean by can they win. So in private markets, the team is everything. There's no public scrutiny. There's no analyst coverage. It's all on the founders and the executives to weather everything that's coming at them. So for venture capital, have the founders built companies before? Do they have deep expertise in the industry? Are they coachable? Will they listen to investors and advisors? Do they have complementary skills? You want a technical founder and a business savvy founder, not two technical founders or two engineers that hate sales, because girl, if you can't, to sell is everything. Like that's what matters the most. It's like if a tree drops in the forest and ain't nobody there or here, it doesn't make a sound. Like if you build this beautiful thing, but you can't sell it, you're lost, you're dead, right? So for private equity, we're looking at, does the management team have a track record of scaling businesses? Are they incentivized properly? Do they have equity in the deal? Are they staying on post-acquisition or are they leaving? The CEO is cashing out and leaving. That's a red flag. Who gonna run this thing? Right? So one thing we do at Margins, we check references. We talk to people who've worked with the founders or executives before. You got to ask the hard questions. But really, like the beauty about it is like this world is so small. We're all 1 to 2 degrees. We used to think it was 6 degrees of separation, but certainly if you black, it's like 1, maybe 2. So if you don't trust the team, then we just don't invest. The beauty about my experience with Margins and running Margins is I know how hard it is and you need grit. And so we don't invest in no soft founders. We just don't. Every company has competitors, even if they claim they don't, like all of them, they're going to be like, well, it's only us in this space, lies. And so we are looking at who else is trying to solve this problem. We're looking at the company that we want to invest in. What's their unfair advantage as well as the competitive advantage that their competitors have. We want to know, is the technology proprietary? What are the network effects? We want to know if they have some type of unique distribution channel that hasn't necessarily been thought of. And we actually want to know, like, can they scale to the size of Amazon, Google? Because frankly, that's the goal. And from a private equity perspective, we're looking at the market leaders in the space. Does this company have a defensible position? Do they have a strong brand, locked in customers, geographic monopoly? Are there contracts to keep the customers locked in? So we want to know, is the industry consolidating or fragmenting? The wealthy look for companies that have moats. And so that's basically what we're talking about. Like for defensibility, you want to look for a durable competitive advantage that protect them from being disrupted. Now, that moat, especially in this world of AI, is not going to be irrefutable anymore. Like it's really only going to give you a head start. Like you grow or die. Like that's what it is. It is not going to keep you safe forever. You're not going to live behind your wall, pull up your little drawbridge and be safe. That is not the case. It'll give you a head start and you have to continue to evolve and grow. You earn good money, real good money, and yet you're still not entirely sure how to manage it and invest it. You've listened to the podcast, you've attended the webinars, and you've already started investing. And somehow with all of that, you're still second guessing and afraid that you won't be able to create that 7 or 8 figure wealthy life of your dreams. The Sovereign Collective was built just for you. A judgment-free and safe space specifically for high-earning Black women who are ready to stop pretending that they have it all together and actually start building generational wealth. We are launching the founding cohort on April 21st. Just 20 seats. 20. Learn more at joinsovereign.co. And remember, you are always wealthy. And then lastly, we're looking for their secret sauce. Like, what separates good investments from great ones? What does this company have that nobody else has? Like, we invested in a company called Fizz. It's a fintech company that was created to help Gen Z college students build credit through a checking account. And they were coming for Discover. Now Discover is owned by Capital One, so now I guess they're coming for Capital One. So I like the fact, sure, that they were a part of Y Combinator. That's fine. I liked the COO. I thought he was sharp as a tack. And I liked that he was from Detroit, because I knew that if he was from Detroit and he was a Black man from Detroit, he got a little grit about himself. I also liked the fact that they were supported by Kleiner Perkins in the pre-seed round, as well as Kleiner Perkins was leading the seed round. Kleiner Perkins is a massive blue chip venture capital fund. And the fact that they had put their money in them twice, as well as made the connections with the banking partnerships and relationships they had. And you could tell that Kleiner Perkins had made other connections with them to help them scale to where they are to Series A. That was the secret sauce that I needed. It made sense to me to bet on this horse that was clearly being pushed by a massive player in the venture capital industry. All right, so let's talk about some key metrics in PNVC. The metrics that you use to evaluate a stock are not going to be exactly the same as you do for evaluating a private equity or a venture capital deal, but this is what I look at. We're going to look at revenue growth rate. Are they growing or are they contracting? If they're contracting, I don't want any part of it from a private equity perspective, because I am not an expert in buying distressed assets. So that's somebody else's game, and that's cool. So the growth rate typically was acceptable for venture capital is 50% plus year over year. Private equity is between 10 to 20% year over year. I'm also looking at EBITDA margins. So private equity, you want 15 to 25% margins. And so that's EBITDA divided by revenue is what that formula is. I'm also looking at LTV to CAC ratio. We've talked about that. From a venture capital perspective, we're looking at burn rate, right? How fast are they spending their cash, and do they have a decent enough runway? And I'm also looking at market size. So this is your total addressable market. That needs to be a multi-billion-dollar opportunity from a venture capital perspective. And that's not saying they're going to take 100% of the market, because that ain't real life, right? So it's like, if they get 5% of the market, can they still reach unicorn status? And that's what I'm looking for. So here are some red flags that you need to be conscious of. Lack of transparency. If the fund or company won't share their financials, their track record or terms, girl, run. Like, girl, bye. What are we doing here? Like, what are you talking about? I'm going to give you money on vibes? Lies. Unrealistic expectations. I just talked about that. If a startup is projecting 500% growth with no clear plan, that's hype. If they're talking about, oh, we're going to have 30% of the market of a total addressable market, we're going to get 30% market share, girl, how? When? Like, not in the next 5 to 7 to 10 years, which is what I'm looking at, right? So you just got to be careful of people who are selling you a pipe dream and are inflating the numbers, because frankly, you want to invest in someone that has their feet planted on reality. There's a balance of delulu, because we do need to have a little bit of delusion that we believe that we can do this very, very audacious thing, but there needs to be some reality and some grounding that supports like your delusion, because girl, like, I got my own pipe dreams. I don't need to fund yours too. Okay. Exit strategy, right? So you need to think about how you're going to get your money back. If there's no clear path to an IPO, an acquisition, or a buyout, then your money is going to be locked up indefinitely, and ain't nobody got time for that. Now, here's something that's interesting with the IPO market. Since it's no longer performing the way it did in the last 30 in years before, like IPOs have considerably slowed and private companies are staying private longer. I mean, just look at Stripe. And so there are some companies that are probably going to stay private longer, but what is growing is the secondaries market. And so what's happening is people are developing this marketplace so that they can sell in and out of their positions on the private companies. I suspect that that's going to continue to grow, and TBD what's going to happen with the IPO market. Things are going to change, right? Like, I don't think it's going to get to the days of yore when there were more public companies than there were private companies, and the goal was always to go public. Right now, 87% of companies that earn $100 million of revenue every year are private, and only 13% are public. I don't know if that's going to drastically change. I certainly don't believe we're going to get to a place ever again where 87% are public and 13% are private. That's never going to happen. So you just want to be thoughtful of like, all right, well then what is your exit strategy when you put your money in here? How to access private equity and venture capital as accredited investor. An accredited investor is an investor who earns $200,000 a year for the last 2 years. As a single person, is married, earns $300,000 a year for the previous 2 years, or has a net worth of $1 million that does not include the value of their primary residence. And the last thing is if you have certain financial certifications like a Series 7, Series 63, and the like, you also are considered an accredited investor. So for those people who want to invest in these deals, they can find angel networks, invest in funds that invest in these type of deals, or they can network their off and get connected to these deals, or they can find secondary markets. There are some secondary markets that only allow accredited investors to invest in. So those of you who are not yet an accredited investor and you're like, girl, what are you doing? Why are you talking to me about this? There are opportunities as well for you to invest. So let's talk about them. There are platforms for everyday investors like AngelList, provides access to certain VC funds and startup syndicates. Republic is an equity crowdfunding for startups. Seed Invest allows you to invest in vetted startup deals. Fundrise also allows you to invest in real estate, private equity. I believe Yule Street has some deals that you can invest in if you're non-accredited as well. Unfortunately, Margins Capital is only for accredited investors right now. The goal is to have a public fund that does not require you to be an accredited investor, but that is not the case today. So just so you know, Margins Capital, we aggregate these type of opportunities to build a diversified portfolio so you don't have to pick individual deals. Like if that's not your jam and you're like, I just want to invest with a trusted fund that will do this for you, then we do that. We do the diligence, we negotiate the deals, and we give you access to institutional quality investments. And our minimum investment is just $25,000, which is significantly lower than your traditional private equity fund that's generally somewhere around $250,000. Unlike other funds or opportunities, what's important to us is that we are providing access to a diverse limited partners or LPs or diverse investors, where you get a lot of funds that are like, I'm trying to give money to diverse founders. So to close, private equity, venture capital are where the wealthy, basically where they're widening the wealth gap between them and us. And you can make a lot of money, but you can absolutely lose your shirt if you don't do your homework. You do not want to skip steps. You do not want to invest based on vibes. And girl, like we're not doing that. You don't want to just lock your money up without understanding all the risks involved. So you want to do your due diligence just like the wealthy do. You want to ask hard questions. You want to demand transparency and only invest when the opportunity and the team and the numbers all align with who you are, how you invest, how you want your money to work for you. If it doesn't, move on. There are plenty of opportunities out here and you will get another bite at the apple. So that is all for today. Today we broke down how Margins Capital and you should be evaluating or conducting due diligence for venture capital and private equity deals. If this episode opened your eyes to the world of private investment, share it with a friend who's ready to move beyond just stocks and bonds. Drop us a 5-star review so more women and people of color can get in on these wealth building strategies. And don't forget to like, follow, and subscribe wherever you get your podcasts on Apple, Spotify, or YouTube. All right, y'all. See you next week.